Something strange is happening in crypto right now. The macro environment is improving. Liquidity is healing. The government shutdown has finally ended. Rates are moving down, not up. And Bitcoin is doing absolutely nothing. 12 months of sideways, 12 months of stale sentiment, 12 months of people asking the same question over and over again. Is this it? A year ago, everyone expected Bitcoin to be far higher than it is today. Instead, it's been stuck in one of the longest consolidation phases of this entire cycle. But according to Lyn Alden, nothing about this period is bearish. Nothing about it signals a top. Nothing about it says the cycle is over. In fact, if she's right, we're not even halfway through it. This interview is one of her most important yet. Not because she gives a price prediction, not because she calls a top or bottom, but because she explains, with absolute clarity, why the trends driving this cycle are completely different from the ones people expect. Today, we're walking through 4 of her strongest ideas, the 4 clips that matter most, and the 4 reasons why the current frustration in the market is completely normal, and more importantly, why it might be setting up one of the strongest periods Bitcoin has ever seen. And if you want to stay ahead of the market to spot when it's heating up or flashing those rare buy signals, join the Crypto Nutshell, my free 5-minute daily newsletter. You'll get quick, actionable insights and the latest news that actually moves markets, all delivered straight to your inbox every single morning. Just hit the first link in the description and enter your email to join. All right, let's get back to the video. Before we go anywhere, we have to talk about the biggest misconception in the entire market, the idea that Bitcoin is in a bear phase, because everything about this price action feels heavy. It feels weak. It feels slow. People keep calling it a breakdown. People keep trying to label it. People keep trying to force this into the old 4-year rhythm. Lyn shuts this down immediately.
I don't think we're in like a full-on bear market. I think we're obviously in a weak portion of the cycle, and Bitcoin has been roughly flat for 12 months now. It's kind of had a lack of catalyst. It's kind of one of those things where, it gets ahead of itself for a period of time and then corrects. And some of those corrections go on for 6+ months. This one basically went on for 12 months, even though there were new highs along the way. I've kind of been in the camp of always kind of being a bearish bull, which is I try to avoid price targets, more focused on direction, because you can't necessarily predict like illiquid moves and kind of euphoric periods or kind of lack thereof. But when I do get kind of cornered into giving a price target, I think one of my main ones was 150K for this year. So it looks like we're probably not going to touch that, but like John said, we still have 2 months to go. So we'll see what happens. And so that's like, we hit 125 or change. I had a similar thing last cycle where at first my target was $1 trillion market cap, which was somewhere in the ballpark of 50K. We touched that. And then I gave a target of, I think we'll hit 100K. That was still lower at the time than many of the bulls. We ended up not reaching that. We ended up only getting to 69. So far we're kind of in a similar thing where we kind of hit initial bullish targets, new highs and all that, but then kind of stagnate a little bit. I generally don't look too much into this whole kind of 4-year cycle aspect. As the halvings continue, the new supply is a much smaller component of the total supply and demand out there. It's more about what price will unlock coins from existing holders. Either because they want to sell into bullishness or because they're, selling into weakness. They're afraid of their position. Either one. That's the type of thing that can, really kind of affect price more so than what is the, kind of the rate of new coins hitting the market at this point. In addition, prior cycles, because it was a much smaller illiquid market, and with kind of, in general, on average, less sophisticated kind of participants, not necessarily in terms of like intelligence or anything like that, but in terms of hedging, in terms of kind of how they tend to rebalance and stuff like that, we had kind of more non-financial people involved. Basically, people that are sophisticated in other areas, not in terms of like portfolio management. It didn't really follow normal rules of assets. Whereas now that it's kind of held by those who tend to hold other assets, they tend to treat it like they do other assets, which often results in rebalancing and things like that.
This is the key to the entire video. She's telling you flat out, this isn't a bear market. It's a long consolidation inside a larger, still intact bullish structure. Bitcoin got ahead of itself, ran hard, made new highs, then entered digestion mode. Sometimes that digestion can last 6 months, sometimes 9. This time it has lasted 12 so far, but none of it signals a structural top. What makes this clip so important is that Lyn explains why the old 4-year halving rhythm barely matters anymore. When Bitcoin was tiny, halvings had mechanical impact. New supply dropping made a huge dent in the total stock of coins. But as Bitcoin scaled, the halving became a smaller and smaller percentage of overall flow. Today, issuance is almost irrelevant compared to the size of the asset and the size of the capital entering and leaving it. So if halvings don't drive the cycle anymore, what does? Liquidity, regulation, institutional flows, fiscal policy, balance sheet expansion. In other words, the same forces that move every other major asset on Earth. And when you realize that Bitcoin is maturing into that kind of asset, the idea of 4-year cycles disappears. The timelines stretch, the amplitude changes, and you end up exactly where we are right now. A long period of consolidation that feels frustrating but isn't bearish at all. This is the new era of Bitcoin. Slower, heavier, larger, and ultimately more powerful. But before we continue, just a quick reminder that only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free. It supports the channel, and you can always change your mind later. Let's get back to the video. If halvings don't drive the cycle anymore, then what does? Lyn answers this directly. And what she says is so important that it completely reframes how you should think about long-term Bitcoin performance. Before we play the clip, think back to late 2021. Inflation was spiking, rates were rising, M2 growth was collapsing. The Fed was tightening aggressively, balance sheets were shrinking, liquidity was evaporating. Every major indicator was rolling over. That entire environment was bearish for Bitcoin, and Bitcoin behaved exactly as it should have. Now look at today. We're in the opposite conditions. Inflation isn't surging, rates aren't rising, the Fed isn't tightening, balance sheet contraction is ending. Deficits are enormous, liquidity is rising, and yet Bitcoin is chopping sideways. Lyn explains why.
I do think factors are the key drivers. Basically, the type of things that drive a lot of high quality assets up, or put kind of near term pressure on a lot of high quality assets. Various things related to the hardness of money, liquidity, that kind of thing. A lot of the factors you cited, and then as you point out, I mean, unlike 2022, we don't see a major contraction in a lot of these things. Instead, some of them take a pause for a period of time. Others are still accelerating. And so I expect the numbers to be pretty good in 2026 and 2027. I think we're ending the period of Fed balance sheet contraction. We're entering maybe a flat period for a period of time, and then most likely expansion for a while. I would say not at the rate that some people think. My general view is that we're not going to get some massive QE anytime soon, but that instead we're going to return to a period of kind of structural balance sheet increases at a moderate pace, and that over the kind of longer term is beneficial for a lot of assets, including Bitcoin. And it's more the persistence of it, kind of the length of it. And I think another factor that kind of weighs it is that because we have a two-speed economy or K-shaped economy, depending on how you want to refer to it, that impacts financial markets too. I mean, we've had kind of a two-speed asset market, which is if you're one of the big mega cap tech stocks or gold or a handful of other assets, you've done amazing. A lot of mid-level companies just kind of chop it along. And in this particular cycle, we have not really had retail investors show up. So you don't see, for example, Google Trends searches for Bitcoin not doing particularly amazing. A lot of the demand this cycle has been on that more institutional side, which includes, higher net worth retail investors as well, and including, of course, some retail investors. But it's not a very retail-driven market like prior cycles generally have been. And that's in part because a lot of retail investors are strapped for cash at the moment. There's not, a lot of them are financially struggling because we have kind of an economic malaise. Kind of the one thing that does look pretty negative for asset prices, but it's kind of the era we're in, is low consumer sentiment. And business expectation sentiment. So a lot of the kind of the boots on the ground stuff is pointing toward weakness. And I would say the key reason for this is fiscal dominance, which is, for the most part, if you had consumer sentiment this bad, it would look like a recession. So a lot of these other things would also be rolling over. But because we have fiscal dominance, we get an unusual separation from things like purchasing managers indices or consumer sentiment, these kind of real-time gauges of the economy. While asset prices can kind of levitate. And that's in large part because of fiscal deficits. And I think that that's kind of a structural thing that we're in now. And so you get kind of pockets of weakness and pockets of strength.
This clip is foundational. It explains why nothing about today's market resembles a cycle top. She confirms that the real drivers now are the same forces that move high-quality assets across global markets: money supply, fiscal spending, balance sheet expansion, global liquidity, interest rate direction, and the most important line of all is the one where she says 2026 and 2027 look strong. She's not guessing. She's telling you that the underlying macro trend is shifting in Bitcoin's favor. QT is ending. The balance sheet is flattening. Expansion is next, not contraction. Rates are coming down, not up. Fiscal spending remains massive, and deficits continue to push liquidity into markets whether policymakers intend it or not. And here's the part investors keep overlooking. Retail isn't here yet. There's no hype, no mania, no frenzy. Google searches are dead. Social engagement is muted. Most households are struggling with the cost of living and simply aren't speculating. The entire cycle so far has been driven by institutions, which means the retail phase, the phase that historically creates the blow-off tops, hasn't even started. That's why Lyn believes the cycle has much more room to run. This isn't a top. This is the middle. This is the section every frustrated investor needs to hear. If the macro is improving, and institutions are buying, and liquidity is rising, then why is Bitcoin stuck? Why did the price stall for 12 months? Why hasn't it reflected the major shifts happening underneath the surface? Lyn explains this with perfect clarity.
TGA is being built up pretty significantly due to the government shutdown. Do you make anything about this actually being a short-term drag on Bitcoin's price in addition to these other factors that we're talking about?
I do, and I would say that those two things are themselves related. So you mentioned repo plus the TGA fill. I think the TGA fill was one of the variables that contributed to the repo stress that we've seen. And for listeners that don't kind of follow it, the Treasury General Account is the Treasury's cash balance that they hold at the Fed. It's like the federal government's checking account, and it's basically a void of capital that's not currently being used. They've issued bonds to bring in that capital, but they haven't spent it yet. And normally they hold a balance. They currently target around 850 billion. It generally goes down very low when they're under like a debt ceiling issue, and it rarely goes higher than their target. And so when they filled it up, it's actually negative for liquidity because it's kind of sucking it out of the financial system. They're basically issuing more bonds than they're spending back into the economy. So they're kind of pulling capital into this void where it's not being used, which means it's less elsewhere where it could be used. It could be levered. It could be used for all sorts of purposes. So they now combined with the fact they were already doing quantitative tightening, so they were reducing their balance sheet. They were getting close to their target levels. So the Fed has published research on this. They are basically trying to reduce excess reserves down to some place that is not super scarce, but that they call ample. So instead of abundant reserves, they don't want to get scarce reserves. They want to bring them down to ample. They're roughly in the range where they defined it as ample. Now, the types of things we're seeing now are supposed to happen under a scarce reserve regime. So some of these things that are happening with repo are not shocking. And I've written about it in my research reports, kind of predicting around this time you start to see it. I think it's a little bit front loaded. So things that could have been happening mildly here and mildly in early 2026 are happening more moderately here in late 2025 because of this TGA fill. So you pulled a little bit more capital out of the system than they expected to, which kind of strained an already semi-tight system. And caused some of this.
This might be one of the clearest descriptions of short-term Bitcoin headwinds you will ever hear. Here's the simple version of what she's saying. When the Treasury General Account fills up, the government is pulling money out of the financial system. That money gets parked at the Fed. It's not circulating. It's not flowing through markets. It's not creating liquidity. And when the TGA refills aggressively, it creates stress in funding markets, including repo. Bitcoin is directly exposed to these liquidity drains because it's one of the purest risk assets in the world. This is why Bitcoin feels like it hit a ceiling, not because demand collapsed, but because liquidity was temporarily pulled away. And Lyn makes it clear, this isn't permanent. It's a timing mismatch, a front-loaded stress event that happened because of the government shutdown. The moment the government reopens and the balance stabilizes, the drain eases. As she puts it, this pressure fades in 2026. That's when the liquidity environment aligns with Bitcoin again, and the temporary ceiling disappears. This is not a bearish structural trend. It's a short-lived macro headwind, and that distinction matters. The final misunderstanding in this market is the idea that OG selling is some kind of fatal blow to the cycle. Every time revived supply spikes, social media explodes. Every time coins older than 5 years move, people panic. Every time a whale sells, someone screams distribution top. Lyn explains why this is not only normal, but expected, and why it doesn't signal a top at all.
One is like in that chart you showed, one of the challenges, of course, is that's in dollar figures. And as Bitcoin gets much larger, of course, the dollar figures for almost everything are going to increase. And if you notice, like the spikes were during major bull markets. So 2017, then 2021, and then 2024. These were kind of periods of major new highs. And what happens historically, we have kind of data of this going back to like 2011, kind of every major bull cycle in Bitcoin's history, is that you get selling pressure from longer term holders when you're kind of reaching new highs and that there's plenty of liquidity to sell into. If you try to sell into a weak market, you get a lot of price slippage. If you're a meaningful whale and you're trying to sell, you generally want to sell into a bull market to kind of sell, and your coins are easily bought by new buyers. I do think that the narrative like the IPO is correct, but it's not unique to the cycle, which is to say that there's some aspects unique to the cycle, but basically you do get that kind of gradual distribution from very early adopters, much like a startup company becoming, a publicly traded, widely held entity. And basically the difference is that Bitcoin is not a security and it's always been public, but you still get that kind of same sort of investor behavior where you get, kind of super high signal or early adopters. And then you get kind of people coming later. They've seen more patterns of it. They've had time to kind of analyze it. They have less explosive upside potential, but also generally less risk by the time that they buy in. And one way to kind of capture this is like people that have been holding for many years are often up 5, 10 times or more, depending on how long they've been holding. It could be many times more. Many of them have, they've aged a number of years. Many of them have families that they didn't have when they started hodling. Many people want to just upgrade their consumption patterns. Some people get nervous by having what has grown to maybe 90% of their net worth or more in an asset, and they might still love the asset, but they might say, well, there's another asset I'd even put 10% of my net worth in. I got 90% of my worth in this one. Maybe I want to go down to 50. So I'm still bullish, but maybe I'm not betting the farm anymore on one thing that they could chop around and do all sorts of stuff. So you get any number of reasons that are pretty valid for people kind of distributing. Sometimes you also have someone that distributes back to themselves, which is they say, I've been self-custodying, what is like now millions of dollars. And maybe I still want to self-custody a bunch of it, but maybe I don't want to self-custody all of that. And so you get kind of potentially selling into ETFs or treasury companies that then that same individual or group continues to hold, just in a different form, which can potentially give them kind of different types of liquidity access and stuff like that. And so I do think what's different with this cycle is that you do have, obviously the ETFs and the treasury companies present new opportunities for the types of selling and distribution that can occur. But I think this is part of a broader kind of pattern that happens, and I think will continue to happen in every major bull cycle.
This is such an important part of the puzzle. Old coins move in every major bull market. They always have. They always will. It's not bearish. It's not manipulation. It's not a sign of exhaustion. It's the natural evolution of monetization. Imagine holding Bitcoin for 7, 10, even 12 years. You bought early. You lived through the crashes. You held through fear. And now you're up 5 times, 10 times, maybe more. It's completely rational to take some profit, rebalance your portfolio, or simply de-risk. This doesn't stop Bitcoin, it just redistributes it. And that's the part people miss. These coins don't vanish. They move into the hands of larger, more stable, long-term holders. ETFs, institutions, corporations, high net worth individuals, global allocators. This is the IPO moment Lyn talks about. Early investors gradually distribute coins to a broader base as the asset matures. The volatility cools. The floor rises, the ceiling is still open. And the long-term trend strengthens, not weakens. Bitcoin isn't being dumped. It's transitioning from its early adopters to its global holders. That's what a maturing asset looks like. Nothing about the current market is inherently bearish. Nothing signals a top. Nothing suggests the cycle is ending. The 4-year rhythm is breaking down because Bitcoin has outgrown it. The real drivers now are liquidity, fiscal policy, balance sheets, and macro flows. The TGA drain and repo stress created temporary pressure, not structural weakness. OG selling is part of every bull market and always will be. And the biggest moves of this cycle, the retail phase, the liquidity expansion, the macro alignment, are still ahead. The frustration you feel in the market right now isn't a sign of failure. It's a sign of transition, a slow, grinding, structural shift that sets the stage for the next large move. This isn't the end of the cycle. This is the build-up to the part everyone remembers.